The Apollo dataset covers 7,000 stocks globally and provides a series of systematic daily indicators, return forecasts, and measures of valuation, volatility, growth, and momentum derived from the Libra Investment Services global equity model Apollo. It is categorized into 4 data types: core components, outputs from the Apollo pricing model; key variables, the series of price-related variables that provide levels reflecting both short-term and longer-term trading ranges, margins and safety, and measures of risk; Apollo forecasts, expected return forecasts, target prices and their associated probabilities; and the Apollo signals, consisting of continuous time series timing signals, inflection points, and measures of significance. Starting with the core components, the Apollo model leverages fact-set estimates for each firm in the system and at each moment in time. Forward median estimates of earnings, cash flow, book value, EBITDA and sales are imported into the model and adjusted in order to provide rolling 12, 24 and 36-month forecasts. The current price is then treated as a dependent variable in a function where a vector of these cash flow proxy forecasts and the discount rate applied to those cash flow forecasts at that current point in time are the independent variables. Apollo uses a maximum likelihood estimation technique to generate a robust, generalized, multi-factor proxy measure of future cash flows updated daily. This is the Apollo fair value, and we can see this as the orange line alongside the share price. This is available for every stock in the system as a daily dataset. The use of multiple fundamental factors helps to reduce forecast error and provides implied factor parameters that demonstrate the time-varying relative importance of the fundamental factors driving the forecast. This second time series chart shows how these drivers vary through time, and these weights are available as a weekly dataset. This dataset offers an important insight into the changing significance of individual firm characteristics in the eyes of investors through time. Apollo then uses an implied cost of capital present value-based approach to determine a measure of the discount rate being applied to the estimate of future cash flows. We can see this in the form of a time series as the orange line on the lower chart. The more negative the level, the greater the discount rate. One of the underlying assumptions of the model is that under a rolling 24-month forecast horizon, the measure of expected cash flow will reflect a long-term growth rate. The importance of cash flow news as a determinant of longer-term growth becomes more significant with extended investment horizons. Therefore, a secondary calculation is run. This uses predictive regressions to extend the separate cash flow measure forecast out to 60 months. It also uses the same multi-factor regression technique to generate a measure of future cash flow that reduces the short-term forecast noise but captures long-term growth impacts from cash flow news. This is the intrinsic value time series and can be seen here as the blue line on the Apollo margin of safety chart, a chart that we will return to. An additional measure derived from the regression line for intrinsic value is a measure of growth, and the strength of the slope provides an indicator of expected future growth, the intrinsic value growth signal, although this is not currently shown on the front end. Moving on to the analytics, these focus on price variation in relation to the independent variables. The share price becomes the starting point, and the measure of deviation between the share price and the current level of fair value provide an additional discount premium time series. The discount premium to fair value is shown here on the lower chart. The historic maximum minima over trailing period can be applied in percentage terms to the current level of fair value to give a guide to the price levels that represent the point where the market applied a most optimistic or pessimistic level of total risk premium. These are not shown as time series, but are available as levels and percentages on the stock screen and are available as time series in the database. A similar time series for a discount or premium to intrinsic value is also available through the data service, although it is not explicitly shown on the Apollo front end. What we can see, though, are the forecast boundaries of the likely risk-reward price range, otherwise known as the margin of safety. These are determined dynamically by Apollo from the measure of intrinsic value which is used as the strike price for a 12-month American option in a real options pricing model. The upper and lower boundary terms represent the maximum value for the call or put options implied by that strike price on a 12-month basis. These can be seen here on the margin of safety chart. And the margin of safety in percentage terms is the discount premium implied by a stock trading at the lower boundary. The current position of the stock with respect to the upper and lower boundaries, where we are within this range, can be expressed in percentile terms, such as the stock trading at the upper lower bound has a value of 100% or 0%. but it is often used as a flag or signal. It provides a normalised measure of current value with respect to systematic risk, which can be used from a stock's own time series perspective and to compare stock values on a cross-sectional basis. By combining both the level of potential opportunity and the implied volatility associated with it, the value indicator demonstrates the current risk-reward trade-off with respect to both expected and unexpected return. From a cross-sectional perspective, the daily re-estimation of the Apollo model means that stocks across portfolios, sectors or markets can be dynamically ranked based on value. The width of the margin of safety range from upper to lower boundary can also be expressed as a time series as a measure of implied overall risk. This is the implied volatility. Turning now to the Apollo signals, and using a combination of core components, key variables and forecast model outputs, this is used to generate a series of continuous time series stock and market level timing signals, inflection points and measures of significance. The first of these, sentiment, is derived from the covariance of fair value and the discount rate, with the possibility of both positive and negative covariance over time. This measure is transformed into a price level with respect to the expected return and represents the trend component of the forecast error. We can see this on the Apollo front end here as the midline on the fair value range chart. A probability distribution is then applied to a forecast of this trend in sentiment to estimate the total return forecast probability distribution, and this forms the fair value range, with upper and lower distribution bounds of the sentiment time series based upon the historic volatility of the unexpected return. The risk-reward implied by the boundaries indicates the degree of potential alpha available, and the position of the share price within that range provides an indication of the short-term risk-reward trade-off available. Finally, you will see the Apollo star rating on the stock in the upper left-hand corner. This is designed to identify opportunity and risk in relation to both expected and unexpected returns, and is constructed using linear signal inputs of value, growth, quality and momentum derived from the Apollo forecast model. The combined output signal takes the form of a star ranking that ranges from -5 to +5 stars, with signal significance starting to emerge at the ±3 star level.